All right. Jason Bible, Texas Real Estate Mastermind. Rob is running around today, doing some stuff, doing some administrative stuff. So I'm here today, give you guys some insight on the marketplace. I highly recommend for those of you who are in real estate to go watch part 2 of Elon Musk's interview with Tucker Carlson. Talks a little bit about economics. It actually talks a lot about residential commercial real estate. It's real interesting. So I'm going to piggyback on some of those comments that he made a couple of days ago with Tucker. And one of them I thought was real interesting, and he's 100% right. If you had to mark to market the bank's portfolios, so what this means is, what if a bank had to sell assets today, what would they be worth? That's really what mark to market means. So they have to, so they got to sell them today. Well, here's the problem. If they had to do that today, I don't believe there'd be a single bank in the United States that would be solvent. I don't believe that to be true. I don't know that to be true, but if they bought assets in the last, 10 years, at least the last 5 to 7, and depending on how much they bought a couple of years prior to COVID and during COVID when rates were so low, those products, those assets, those notes that they bought for 2, 3, 4% are now 5, 6, 7%, and they're essentially worth half, if not 40%, of what their original purchase value was. And he's absolutely right. If you really have to go mark to market on these banks right now, I don't think there's a single one of them that is solvent. Now, I could be totally wrong here, but let me put it this way. It's more than one and less than all of them, but it's somewhere in between there. So you've got all of these potential losses in commercial real estate, actually in mortgage-backed securities and commercial real estate. And one of the things Elon has said, that commercial real estate used to be one of the gold standard investments that one can make. Relatively low risk, relatively speaking, you're still considered, according to the FTC, they're considered high risk, but relatively low risk to a basket of other equities and bonds and that sort of thing. What I have said since COVID is COVID completely shifted residential and commercial real estate. We found out real quick that if commerce was not taking place, in other words, the country was shut down, commercial real estate's value was greatly diminished. We knew that in COVID. In fact, if you're a business owner and you have two choices or one choice to make, pay your mortgage on your office building or pay your mortgage on your house, more than likely you're going to pay the mortgage on your house. Single family real estate really flipped the script during COVID, and it became the most important asset class of any type of real estate. I mean, people really didn't want to live in apartments in the middle of COVID. When the chips are down, residential real estate seems to be the safe haven. So now we've got some challenges in certain markets, not all of them, but in certain markets where these commercial mortgage-backed securities and just general mortgage notes for commercial real estate have lost a significant amount of value because interest rates have gone up so much. That's just a fact. Now, if we start seeing a rash of foreclosures across the country, all of a sudden the mortgage-backed securities that these banks own also is greatly reduced in value. I don't believe we're going to see that, but just know that that is the doomsday scenario. If you guys remember back to 2007, 2008, commercial real estate was doing relatively well. I mean, there were some challenges in the credit market with obtaining credit, but for the most part, the rash of foreclosures was all in residential real estate. If you have the perfect storm of both of those being written down and written off, you're talking about a massive, massive reduction in value. You're talking about a real crash. I don't believe that to be true. But just for the sake of this discussion, that's where we're at. Now, the question is, how do you keep this from happening? And Elon was 100% right. There is only one way out of this hole, and that is lowering rates. That's why I've said for almost a year now, these rate hikes are temporary. In fact, they've always been temporary. If you look at the 30-year fixed rate mortgage chart for the last 50 years, you'll see it. Rates continually get lower. That's just the reality. So if they want to bring value, the Federal Reserve, want to bring value back to these banks' portfolios, all they have to do is lower rates. And I think they know that. If you go and look at your CD rates and your money market accounts, what you will find is rates are higher in the short term until about 24 months. And then the interest paid on those accounts drops rapidly. So the market consensus is that banks and other investors don't believe these rates are going to last. And I think they're right. I mean, you're sitting here in an election year, increasing rates. And by the way, inflation isn't going to stop. He mentioned this, and he's 100% right. Inflation is not going to stop. You have a growing population. You have a growing consumer class. You've got an expansion of productivity in the marketplace that requires an increase in the money supply. That's why it's not tied to gold anymore. I think the gold guys get this all wrong, where they're like, every dollar needs to be this many ounces in gold. And I'm like, okay, well, your economy's not going to go anywhere. You're not going to be the reserve currency of anything because you just don't have enough gold. It doesn't make any sense. Asset-based currencies don't really make any sense if you're going to use them as a medium for exchange and international trade. So the inflation that we're experiencing in this country is not nearly as bad as other countries. And I'm not talking about, the Congo here. I mean, the UK was happy that their rate of inflation, their version of CPI, was only up 10% year over year. So you're living in the UK, things have gotten a lot more expensive in the last couple of years, especially in the last year. So let's back up a second here. I have one of the things I've always said is residential real estate. The challenge in residential real estate is how much can you buy? Commercial real estate, you can buy a handful of buildings and you are sitting pretty for the rest of your life. Residential, you got to buy a lot more. Even apartments. I consider apartments residential for the sake of this discussion. I know everyone's going to flip out. No, it's commercial. No, it's not. It really isn't. I talked to a lot of commercial real estate brokers out there, and maybe 50-50, maybe as high as 70-30. Think this way. Multifamily is residential. It's not commercial. Commercial is office space, light industrial, healthcare or medical. It is those types, hospitality. It's those types of assets. It's not multifamily. Now, when you talk to a commercial mortgage broker, they're going to tell you multifamily is obviously commercial. But for the sake of this discussion, I really put residential over to one side, including multifamily, and then commercial is kind of on the other side. Should you do both? Absolutely. But when you're starting out, that commercial is real tough. It is real tough because they're going to look at your experience as an operator. And if you have zero experience as an operator, you better have a lot of cash. So anyways, what I think Elon said is absolutely right. The only way to solve this crisis is to lower rates. Because right now, if banks really have to do mark-to-market accounting, they are going to be completely and utterly underwater. If there is a bank run in the United States, the only way to survive it is either by A, lowering rates, or B, injecting a massive amount of capital in the banking system. And the Federal Reserve and Janet Yellen of the Treasury have already said they're going to do that. It's Jason Bible, Texas Real Estate Mastermind. All right, welcome back. Jason Bible, Texas Real Estate Mastermind. So what's really going on here? And anybody who's watched the market kind of knows this, and that is they can't keep raising interest rates. In fact, we're about to hit a debt ceiling. I want to say it's going to be December. There's already some debate on the debt ceiling talk. The challenge is rates keep going up. The federal government has to pay more for some of its debt, which is impacting the debt ceiling. I saw one proposal, I don't know who from, but they were talking about 1.5 trillion. Big number. So rates can't go up forever. Of course, I do remember not too long ago, and I'm not going to call these YouTube channels out, but a lot of people were talking 10% mortgage rates, and I'm like, not going to happen. Absolutely not going to happen. In fact, if you guys saw the news from last week, the Biden administration, through FHA, is now allowing folks with lower credit scores and higher debt-to-income ratios and lower down payments to get better rates and terms than those people who have higher credit scores, lower DTIs, and just a better borrower. Now, is it going to be a whole lot? No, they're talking about on a $400,000 loan, it's going to be about $500 a year. They're going to penalize better borrowers to pay for, and this is my guess. Me and a couple guys were talking about it one of the back channels in our WhatsApp group. My guess is they're going to use that extra $500 a year from the good borrowers, let's call them the prime grade A borrowers, to subsidize private mortgage insurance, PMI, of less desirable borrowers. That's kind of how that's going to work. Is that a good thing? I don't think so. But, I mean, it reeks of 2008 all over again, doesn't it? I mean, here's a family, 760, 800 credit score. They're putting 25% down. You know, mom and dad have got a great job, very little debt, and they are going to be penalized on their mortgage to subsidize a new home buyer who has less than a 680 credit score. I don't understand it myself, but I do understand this. Millennials are the largest voting bloc in the United States, and a lot of them have a massive debt load. Their credit scores aren't great. And because they're one of the largest voting blocs, they got to get their cheese. They got to get their goodies from Uncle Sam. And how are they going to buy those votes? By getting them houses. I have said this forever. I think we're also going to see a lot more 40-year mortgage options. It'll be a 10-year interest only with a 30-year, at the end of year 10, it'll be a 30-year AM, traditional mortgage. We know this, since 2010, the real estate market, everyone keeps talking about 2008. I don't think 2008 matters as much as people think it does. 2010 is when the mortgage market really changed. Somewhere around 2010, Americans started staying in their homes much longer. In fact, that's what you can see. Starting about 2010, you could see the reduction of inventory. There just weren't a lot of people selling homes. We're down around 980,000 right now in inventory across the United States. A normal market is somewhere between 1.2 and 1.6 million homes. I mean, it could be a little bit higher, closer to 2 million, but we are well underwater on the number of homes that we need. I think we're still 50% below 2019. In fact, by the way, if anybody from HAR is watching, they just updated their reports a couple of months ago where they started comparing last year. So they'll do a year-over-year comparison, and then they'll do a comparison to 2019, which I think is good because it's a good idea to kind of look at the pre-COVID versus post-COVID. Although here's the other thing I'm going to say. We are going to look back and say there were 4 events post-2000 that really changed real estate, in particular single-family real estate. Obviously, the crash in 2007, 2008, the inventory reduction starting in 2010, COVID, and then post-COVID. There's going to be those 4 eras, if you will. You could argue changes in bankruptcy law in 2005, 2006. That had a big impact on housing, but that kind of gets into the nerdy economist talk. So since 2010, this is a completely different world for single-family real estate. Folks just are not selling their homes, period. And why is it? I talked a little bit about this on last week's show. If you look at the median-sized house, 15, 20 years ago, it was 13, 14, 1,500 square feet. The last couple of years, the median-sized house that's been built is 2,700 square feet. So people are not moving because they're forming families. They already bought the big house. They're like, do we really need a 3,800 square foot house? Do we need a 5,000? No, it's 2 kids and a dog. I mean, what else do we need? And a lot of times they bought it right. They've got a ton of equity, and it's like, yeah, I'm not really willing to double my mortgage payment and my taxes and my insurance and a higher HOA unless I really have to move. So part of it just has to do with the fact that folks aren't moving because they already have the big house for the family. That's why they stay put. Actually, one of our partners here sold one of his houses. I can't remember how big it is, 4, 5, 6,000 square feet, something like that. Pretty large house. And he said, you know who bought it? It was a young family, just had their first kid, and they're going to grow into it. So you know when they're going to leave? Probably never. It'll be for the retirement house. They'll be in that house 20 years. 25 years. They're not going anywhere. As long as they don't get relocated for jobs. And even now, I was kind of joking the other day. Somebody kind of close to me been talking about jobs, job changes and all that. I'm like, worst case scenario is just go find a new job. I mean, there's only like 100,000 job openings in Houston alone. I don't know how many it is. It's a ton though. Well, what is there? Is it just now 10 million job openings? I haven't looked at the JOLTS report in a while. But 7, 8, 9 million jobs, I'm going to guess like 10 to 20% of those, maybe as high as a third, are in the Gulf Coast. Like not too far from, it's probably pretty safe to say there's 100,000 job openings here in Houston, right? Plenty of jobs here. Companies looking for competent people. Pretty easy to go find a new one. So I would argue that when you're looking at the real estate market, what really matters is 2010 and 2019. We had this massive reduction in inventory that was related to just a limited amount of construction, but most people just didn't need to buy another house. They already had the family house. So what does this mean for you guys as real estate investors? Well, you've got to deal with lower inventory, and you've been having to deal with that since about 2010. Now, most people didn't notice it. Everybody noticed it during COVID, right? Because between now and 2019, if we went all the way back to 2019, we've lost 50% of the inventory. We are down 50% since 2019. We have half as many homes to look at. In fact, I can see it on our side. I'll have a week or two where there's just really nothing coming on the market. Even wholesalers are sending out the same tired deals over and over and over and over and over again. And what's interesting is sellers aren't walking away from wholesalers. That was pretty common, where if somebody couldn't sell a house, with a 2-week close, maybe a 4-week close, that off the market deal would just say, all right, let's execute the contract, let's terminate the contract based off the option and move on. But now we're just seeing them they're stale. They just keep getting sent out. We're starting to see the same thing in the marketplace. We made a handful of offers here in the last 2 weeks where we're the only ones buying. I know we are, because they don't have any other offers. And we send them in, here's this offer, and they're like, no, we need this. And it's like, well, this is all I got. Like, this is the only way this deal works. We're actually looking at a 2-house package. Needs a ton of work. We offered 85. They want 110. And I'm like, there's no way that thing works at 110. There's just too much construction. Okay, we'll just let it sit on the market. Well, I'm like, if it doesn't work for me, it doesn't work for anybody else either. Unless you kind of don't know what you're doing, you end up losing a bunch of money on it. But it's a really interesting market these days. And what I'm really interested to see is as rates come down, what's going to happen to demand? Demand's going to go up. But are we going to see any increases in inventory, or are a lot of these homeowners just going to say, I'd like to buy another house, but I got a really low mortgage. Maybe I'll just rent it instead. And we create a whole new generation of landlords. This is Jason Bible, Texas Real Estate Mastermind. I'm ending them quick for you. All right. All right, ready to go? All right, it's Jason Bible, Texas Real Estate Mastermind. So now what? Jason, what are we going to do next? We're going to keep buying. We're going to keep buying. In fact, one of the things that I'm going to drag Rob in begrudgingly is we're going to start doing ground up again. I think I've got a project right now where I've got to build 5 new homes. I'm just waiting for approval from the city. So it is just a matter of time until we start adding to that inventory. By the way, multifamily construction is at I don't want to say it's an all-time high, but the last time there was this much construction was 1973. That is a lot of construction. So the construction industry went from doing single family, now they're just doing multifamily. And they are putting up a massive amount of multifamily. Jason, is that going to cause a problem? You bet. That is a lot of new product coming on the marketplace by late 24 and early 25. So that's going to affect your absorption rates. That's going to impact rental rates. It's going to impact time to lease. So you're going to start to see a lot of concessions on financial statements. In fact, if I'm looking at any PPM right now, depending on the submarket, now, a lot of the markets we invest in, I'm not seeing it. But a lot of you higher in Class C, let me put it this way, Class A areas, Maybe you have a Class C product in a Class A market. I'll give you a great example of that. You could have an older apartment complex in Spring Branch. You can have an older apartment complex in the Galleria. I actually looked at one years ago in the Galleria. Should have bought it. You can have a Class C product, because that's really, Class C means really when it was built. So you could have an older apartment complex in the Galleria. And here's going to be the challenge. They're going to have, the renters are going to have their option at a lot of really nice Class A properties. Which one do they choose? Do they even look at a Class C unless it's greatly discounted? And I've actually noticed the Galleria, Post Oak, all that areas had a massive amount of growth the last couple of years. Now, I haven't looked at the numbers. I'm just giving you guys kind of an example. So don't start sending me emails. Well, Jason, there's only so many coming on board. And blah, blah, blah. This is the absorption rate that they're predicting. I'm like, no, I just use it as an example. Galleria in Dallas, Galleria in Houston, everyone kind of knows, kind of nicer area town. So a lot of apartments get thrown up that are, quote, Class A apartment complexes. They look like resorts now. They don't even look like apartments. So we're going to start to see that impact some deals. Now, imagine fast forward a year or two from now, they're not able to clean up the CMBS mess. So we've got increase in taxes, increase in insurance, more product on the market, meaning more competition in a submarket. What's naturally going to happen to the price of some of these higher end apartments? They are coming down. But here's what I would also argue. If you want a shot at a really nice Class B or like a Class A minus, this might be the time to get in. I mean, if there's any time, it's going to be here in the next 2 or 3 years. Can you snag a really nice 250 unit apartment complex that was built in 2019? I think there's going to be some of those little opportunities out there. There's not going to be a bunch of them, but there's going to be some investment group, some pension fund, some insurance fund that's like, hey, we made money here. We didn't make as much. We should have sold this in 22, but we're going to sell it in 25. We're still going to make money, but we're going to take a little bit of a haircut just because the market's changed a little bit. And let's go ahead and take our money out of this risk asset and go put it into something else. Treasuries, maybe another apartment complex somewhere else. Maybe they're going to do new construction, whatever. But there will be some opportunities for these higher end properties. Don't doubt me on that one. There absolutely will be. Is it going to be 2008 and the world's going to be ending and there's going to be like foreclosure and like crime scene tape around all the apartments? No, that's not going to happen. But will you be able to get something 10, 15% off that you could a couple years ago? Probably. And to get something real nice, these are the times in which real investors are made. These are the times where you can make a lot of money when no one else is in the marketplace. It is amazing to me I can actually see it on our numbers, to see the number of investors decreasing. Well, let me put it this way. The number of would-be investors. I'd have to look at the most recent NAR report, but the last time I looked at it, the difference between, and I think it was either December or January's data, but the difference between this year and last year, it was like 38% of the market were investor buyers, and this year it's 28%. So it only reduced by less than 10%. I know, that was quick math. And everyone's like, well, Jason, that's only 2%. No, it's 30%, 10% is 3 is about 20, so it's like 15%. I know that was quick math for everybody, but so it was about 15% reduction in investor volume. But what about all the new investors getting in the marketplace? Well, they're kind of scared. I mean, the new investors are scared to begin with. I mean, they're just skittish. So then you get thrown into this, oh my God, I hear home sales are down. And most people cannot distinguish between home sales and home prices. Oh my God, home sales are down. That means market's crashing. It's not what that means. It just means there's fewer sales. Buddy of mine sent me a text yesterday and he was like, hey, home sales are down. Closings are down between last month and this month. And I'm like, yeah, interest rates went up. But where have home prices gone? They're about steady. I think in California, they lost 5 or 6%. So people are telling me like California market's going to crash. I'm like, that market went up like 60% in 3 years. I think they can give a little back. That's what that's called, by the way. You can give a little back to the marketplace. So I wouldn't worry about some of this, is this, is that stuff. Like it gets, here is what I know about real estate investing. Here is what I know. You're buying a property, you're putting a 30-year mortgage on it, and it produces cash. And that in the long term almost always works. What happens if there's a fire? That's what you got insurance for. What happens if there's a hurricane? Insurance. What happens if there's a flood? You got insurance. What happens if something really egregious happens and the tenant sues me? You got general liability insurance. What happens if the market crashes? You have a tenant in there. What do you care what you paid for it? Your net worth takes a dip for a while, but you still have equity in it. And this is the argument I make. If the marketplace dips, I'm buying the one next door and behind it and the one across the street. I will tell you this. I'm not the crash guy because I think there is a huge human toll that is waged on folks when their house goes into foreclosure. Like suicides go up, drug use goes through the roof, divorces go through the roof. I mean, it's not fun. Don't get me wrong. I would love to be able to pick real estate up at 50 cents on the dollar. It just ain't happening. It just ain't happening. One of the reasons that a market crashes is because there's no money. And lenders are still lending. I mean, Jet Lending is just giving us piles of cash to go buy stuff. We're doing a bunch of deals with them right now. And we asked them, like, hey, what do you guys see out there? Like, I mean, we're being a little more cautious, but it's kind of business as normal, man. A lot of people out there buying still. I was looking at a submarket today, kind of upgrading and, I shouldn't say upgrading, but updating my personal balance sheet and schedule of real estate. And one of my properties went up another, I had it listed at 229. There is a sold comp at 249. And there's another one right down the street. Now, they did a crazy good rehab on it, like vaulted the ceilings, did all kinds of stuff that I probably wouldn't do. But they did a massive amount of work on it, and this thing, new high comp at 270. I'm into this thing for 110. But it's appreciated 20 grand since January. And in that submarket, I'm seeing sales in less than a week. It's Jason Bible, Texas Real Estate Mastermind. Knocking them out. All right. Welcome back, Jason Bible, Texas Real Estate Mastermind. So here's what I'll tell you. And Elon said this too. He said, there's only been one time that we were raising rates into a recession. And that was 1929. Which I don't want to say that resulted in the Depression, but it certainly didn't help. Now, our banks and our economy and all that are wildly different than they were in 1929. They're wildly different than they were in 79, even 2010. Banking system is really a global banking system at this point. So any what's called a contagion that occurs in one bank spreads quite quickly to the international kind of banking syndicate, if you will. That's why all these central banks got together and the Fed essentially opened up its borrowing window to allow additional liquidity to any bank that needed it. I mean, Deutsche Bank was the first one that jumped in with both hands. So what does that mean? They're just backstopping losses. And I've said this time and time again, you will not see a 2008 style event ever again. They will not allow that to happen. They will print money into oblivion before people start losing their homes. They did it during COVID. That's exactly what they did during COVID. When we had a conservative president and a conservative Congress. That is exactly what they did. This was not some wild-eyed Democrat, socialist Bernie Sanders plan. This was the conservatives running the ship and said, print money to keep people at home. So you really think there's any politician that is going to stand up there on Capitol Hill and say, everybody needs to lose their homes because these banks need to go under? It's so funny. And this was said during the SVB and Signature Bank bailout. And that's exactly what they were. Those were bailouts. Everybody's a libertarian until it comes to their money. When it comes to your money, it's like, oh no, we got to bail these banks out. Like I got 20 mil over there. Like we need to bail these guys out. Oh no, it's business bank. That's all for employee. You know how funny that went? No, this is all for employee payroll. Like you can't let these banks fail because these uninsured accounts, the reason there's so much cash in them is because it's for payroll of some tech company in the Bay Area, which is all nonsense. I mean, granted, it was there, but Roku had what, 30 or 40% of its cash was sitting over at SVB. That was not for employee payroll. I just tell you that right now. That's not what that was for. Now, as a small business owner, we have multiple accounts that are well above the $250,000 limit. We have a bunch of them, but they're all at Chase. Because if Chase is going down, everybody's going down. There's only one bank bigger than Chase, and it's called China. There's 5 banks in China that are all Chinese banks, and they are bigger than Chase, and that's it. Like the China. I haven't heard China in a while. Somebody cue up Trump. So Chase isn't going anywhere. In fact, if you guys read the earnings report, Jamie Dimon was elated. They had a huge month, huge quarter, because everybody looked around and said, why do I have piles of cash in these little regional banks? Like, this is crazy. And they went over to Wells and Chase in a big way. Chase is effectively the United States government, and let's just be honest. Now, I will tell you, Jamie's a pretty sharp guy, so it's not, they got a smart guy running that operation. But still, it is a big bank. So when you start looking around these regional banks, like, I'll hold till the limit, but I'm not leaving a dollar over my FDIC limit. Because I don't know what's on a bank's books. I really don't. SVB didn't disclose, they weren't required to. SVB didn't do anything from a regulatory standpoint. They may have mismanaged some things, but they didn't do anything illegal, at least that we can see now. They just had terrible risk management. But it wasn't like they were hiding money. It wasn't like Sam Bankman-Fried was over there, helping them with their deposits and putting a couple bucks in his pocket, while deposits were coming in. Like, that wasn't what was going on over there. They just had bad risk management, which is sad because there were a lot of sharp guys putting their money in that bank. And you think guys that understand finance at that level can lose money? You think you can? At a bank. Here's the crazy thing. Everyone's talking about risk in real estate. There were some people that almost lost some real money at a bank. I mean, what is this, like 1919 all over again? I mean, millions and millions and hundreds of millions of dollars at a bank. I don't know anything you can invest in aside from doing something stupid in Vegas where you can literally blow $100 million in a day. I mean, that's what was going on over SVP. Those accounts would have evaporated overnight if they didn't step in. So I don't know. It's fascinating when we talk about risk that way. Then somebody says, well, my regional bank won't do that. I'm like, you sure? You absolutely know what goes on in those 4 walls. I can't remember who said it, but they called their banker and said, hey, man, would you ever tell me if anything was wrong at the bank? Oh, he said, hey, what's going on over the bank? Oh, man, everything's great. We're not like SVB. Like, it's totally cool. And then he said, would you really tell me if there was something going wrong? Oh, yeah, of course. You know they wouldn't. They'd already be sending out resumes. Well, looks like this one's over. Well, this was fun while it lasted. So this whole idea that your local bank can't go under that's nonsense. So that's why the federal government had to step in. But they can fix all this tomorrow. All they got to do is lower rates. But Jason, inflation is going to go through the roof. They can't stop inflation anyway. There is nothing that is going to stop inflation. Nothing. Well, I mean, the nuclear war would, well, actually that wouldn't either because you'd have huge supply shocks. Part of the problem is we just don't have enough goods. There's not enough stuff getting made. That's the problem. If you don't make enough stuff, there's not enough stuff to buy, and the prices of that stuff goes up. It's very simple. So how do you stop that? How do you slow that down? Well, you make sure people don't have enough money. And that's what the Federal Reserve actually wants. They want a job loss recession, which is not good. It's not good at all. And then I would argue, why does the price of anything really matter? If the price of labor is going up, in other words, you're getting paid more, you have more job opportunities, you got more opportunities to go up and move up in a company or move to a different company for more money, then take it. They're paying out there because they have to if you got real talent. It always amazes me still since COVID. I do not like sitting in a restaurant unless it's a really high-end restaurant. Well, with the exception of Papacitos over here, they do a really good job by our office. We're there like 3 or 4 days a week. I asked the gal that seats us, the hostess, I said, is there anybody here as often as we are? She's like, nah, I think you guys are probably number one customers here. So they've always had good service, but even then it was a little tough as they were coming out of COVID. If I go to any restaurant around town, with exception to a really high-end one, and high-end, I guess, is Brenner's, like Brenner's on the Bayou. If you guys haven't been, it's fantastic. And we're almost into, like, this is a good time of year to go to Brenner's and sit on that patio. I'm telling you, it's great. Brenner's, Steak 48, Seasons, Capitol Grill, all those places usually have really great service. They should. But if I'm not going to a place like that, I usually sit at the bar because I can order from the bartender. And they'll typically take really good care of us. But where's all that labor gone? That's the wild thing. The labor just hasn't come back. And no one can explain why. I've heard a couple of things economists have said, but they don't make any sense. So the labor market is going to become more expensive. So they're going to have more money to go buy stuff. So guess what? The price of that stuff's going to go up. Price of stuff never goes down. So I keep telling you guys. So I'm like, buy real estate. Why? Because it's not going down. There may be a crash. The worst crash in real estate lasted 18 months. Your price of real estate went down for 18 months, and then it shot up after that. It's Jason Bible, Texas Real Estate Mastermind.